Well, first, it's great to be here, and you've really done a great job with putting this community together. So thank you for having me. I used to run a hedge fund, and I sold it, and I started investing. And we currently work with about 100 family offices, anywhere between 250 million to 30 billion. And I put a little money in, they put a lot of money in, and we just invest in the private markets, so private equity, venture capital, real estate credit. I do it, so I call it first call alpha. I don't charge anything, but it enables me to be the first call. I don't have enough capital to put in 50 or $100 million into each deal, but I could put in a little bit of money and cobble together the other family offices. So, we structure SPVs and just in the private markets. Um, I sit on a few boards also, and I run a couple Tiger 21 chapters. And then I also helped to launch the Family Office Initiative at Stanford, and I'm about to launch the Family Office Initiative at University of Chicago, which will be announced publicly. Actually, I guess it's just been announced publicly, um, but it will be announced publicly in next month or so. What I wanted to talk about more today was more from a macro standpoint, and kind of how a couple of trends I see in the family office space. Post crash, pre COVID, everything went up. So you got private equity, venture capital, real estate, credit, Bitcoin. No matter what you invested in, went up. And as a result of that, a lot of the family offices started doing direct investments. But the rationale for doing direct investments was, why should I pay 220? I could do it myself. And I think that worked for a while, because everything went up. What I see happening is, as we head into a recession, and I do think it's going to be a little deeper recession than most, um, a lot of these family offices, these investments aren't going to work, and they're going to realize there's a skill set for people who invest in private equity or venture capital or real estate. And I think there's going to be a backlash, and there's going to be less direct investments for the people who aren't necessarily qualified to do them. They did make money post crash, pre COVID, but there was an element of luck. There were some tailwinds that they had behind them. And I think what's going to happen is more and more of these family offices who are going to lose money. And I don't think these in the private markets, it's been mark to market. I think probably by first quarter, maybe second quarter, you're going to see a lot of people scratching their heads to see where their investments are. So I see this as a huge opportunity for people who are experts in a niche, whether it be real estate, whether it be venture capital, whether it be private equity, credit, whatever it is. And the trend that I see is family offices, if they made their money in real estate, they don't need help in real estate. They could do that themselves. If they made money in private equity, they don't need help in private equity. They could do that themselves. But the other asset classes, I think what you're going to see is outsourcing. And I think you're going to see a trend. More and more people will become the outsourced real estate arm, or the outsourced private equity arm, or the outsourced venture capital arm for these family offices. And I think this is going to happen because if you think about it, it's really expensive to have a proper team do it. And I think what's going to happen now, people often ask me, how much money do you need to have a family? And there's no right answer. How much do you need? I would say minimum of, if you're going to invest in the private markets, a minimum of $250 million, probably $500 million to have a team doing it. And a lot of the family offices have one or two people who are doing venture and private equity and venture capital and real estate, and they're not really equipped to do that. So I think there's a huge opportunity right now, and I think the trend is going to be that the family offices, rather than hiring people in-house and paying them $250,000, $500,000 to be part of the team, are going to outsource the private equity side, or the real estate side, or the venture capital side. And it's a huge opportunity if you're an expert in one of those niches. And I think that's a trend that's going to continue to accelerate. And I think a lot of the family offices, got in over their skis. Fortunately or unfortunately, however you want to look at it, everything did go up during a 10-year period. It's not going to happen going forward. So I think there's a huge opportunity right now for people who have an expertise to go to family offices and say, I would like to be your outsourced venture arm for what you do, or your outsourced real estate arm. And it exists to an extent, but it's not really formalized. And I also think that family offices, in general, and I speak and I write about this a lot, they're very fragmented and they're very inefficient and they're very siloed. And I write about this a lot. I think we're only in the third inning. And I also think we're at an inflection point because I think that people are going to start to realize the value of patient capital. And it all basically comes back to alignment of interest. So where in the early 80s, when I graduated from Northwestern, I started at Drexel Burnham in 1987. In the early 80s, mid 80s, the private equity and venture capital, that's when they took off. And they took off because it was a better model than the public market. Because when I ran my hedge fund, nobody in this room could run a company efficiently and have to report to me every 90 days or report to an analyst every 90 days. You're just managing your earnings. So it was a better model. The problem that I see is that many of the private equity and venture capital firms, again, I'm generalizing, and I do invest in funds in private equity and venture capital, but many of them have bastardized the business and it's become an AUM game. And what should be a $500 million fund is a $5 billion fund. And I'll give you just a real quick example, and then I want to leave this open for some questions. I had a close friend who did a roll-up of logistics companies, and he had a great track record, needed $150 million. Placement agent was able to get him $500 million based on his track record. Friend said, well, okay, I just need 150, let's get started. Now, for all you New Yorkers on here, I'm going to be a bit insulting, but it's okay because I used to live in New York. Only in New York did this happen. The placement agent literally came to my friend's house and wrote down 2% of 150 million equals X and 2% of 500 equals Y. What am I missing? So my friend, who's a fairly educated person, a bit incredulous, said, well, what you're missing is if I do what you want me to do, there won't be a fund two because I can't deploy the other 350. I can deploy 150, but I can't deploy 500. And I think that's a microcosm of what's gone wrong in the industry. It's become an AUM game. So I think that as private equity and venture capital disrupted the public markets in the early 80s because it was a better model based on alignment of interest, I think you're going to start to see, we're starting to see family offices disrupt private equity and venture capital because of the patient capital. It is a better model if you have the proper infrastructure. And you look at some firms like the Pritzkers and the Dells and the Bloombergs of the world, they've institutionalized it, right? They can compete directly with Carlyle or Blackstone. Most family offices can't do that. But I do think that because of the model where you're incented to flip companies every 3 to 5 years, the patient capital model is a superior model if you have the right people. And the last thing I would add is that in family offices, I think it's not that complicated to make money, creating alpha, financially engineering a company. A lot of the private equity firms and venture capital firms have finance guys there. And I'm a finance guy too. There's nothing wrong with that. But I do think that in order to create true alpha, you really need to be able to operate. So I'll leave it at that and kind of happy to answer any questions. But those are a couple trends that I see. And I also see that every bank, law firm, accounting firm, everyone's trying to get into the family office world. It's, like Al Capone, why did you rob banks? This is where the money is. And the money is mind-boggling. It will be, if there's roughly $10 trillion in capital today, you've got 65 trillion coming downstream from the baby boomers, the next gen in the next 15 years. There's $4.5 trillion in capital worldwide in hedge funds. So this is currently bigger than the entire hedge fund universe. In 15 years, family offices will be larger than the private equity and venture capital markets combined. But what we have to do as an industry is become less siloed, more efficient, less fragmented, and collaborate more. And that's one of the things that I'm trying to do. I did at Stanford. I'm trying to do at University of Chicago as well. So I'll leave it. I'm open to any questions you've got.
Thanks, Ron. Really appreciate it. I've always enjoyed our bantering back and forth, and we've never met in person. We got to fix that.
I don't know that you exist.
Right. Or
I know Rich,
avatars.
oh, I did meet Rich. I did, and Rich was
Yeah,
great
Rich
to meet.
Sobel.
I know he exists.
So I have lots of questions and comments on that, but anyone want to reflect on or react to what Ron just talked about? Does anyone disagree? Well, one thing, then three things, Ron.
No, this might not be the best question, but
Don't start with that.
can you just provide more clarity on what you meant by the AUM game? I know.
Yeah, it's become an inherent conflict of interest because if you can make, the model was structured where 2% covers the overhead and 20% I make money if you make money. So it was a great model and interests were aligned. I think that many private equity firms and venture capital firms realize that if you're making it to make 2%, it becomes an annuity every year, irrespective of how you do. And I think that's why you have these massive funds. And if you look at the alpha that's created, it's not the huge KKR funds that you want to invest in. It's the smaller funds. And a lot of these funds they've become too big. I mean, if SoftBank has $100 billion fund investing in venture capital, that's insane. You can't deploy that amount of capital. So I think that it's become an AUM game. It's become an inherent conflict of interest in many, and again, I'm generalizing, many of the private equity and venture capital firms realize that an annuity stream of 2% every year on a big dollar amount is a good business model for them.
Thank you.
So I was just going to reflect. I was for 10 years. Sorry.
Mark, Lee has a question.
Sorry, Stephen.
Lee has a question or comment.
Yeah, but actually a statement of support. Josh Lerner, who's one of the two great professors of maybe of three of private equity, has been studying the issue of persistence between Fund 1 to Fund 2 to Fund 3 to Fund 4. And he's really come up with, the results are highly random actually, which is disturbing. But he did find that supports what Ron's saying, sort of four things. One, there's persistence, better persistence if there's a narrow focus of what the group invests in. So that supports what Ron's saying, hey, have an expert in each one of your verticals you invest. Two, you need a stable team making the investment. If people are being moved to other funds or going from real estate to distress, bad things happen. Three, that stable team invests in only same size deals. So one of the risks to massive growth of fund size is that you have to do bigger deals and then you're not an expert anymore in that area. And fourth, and intriguingly, diversity in the investment team leads to better results. He's not making predictions on why, he's just giving correlations. But those are the four things. I'd add that at least for us, our LPs, who tend to be very large, actually control how large our next fund is. They don't want us to be much bigger or vary from our verticals we invest in or the size. So it becomes a real partnership. But we have truly investors that can help control that.
Thanks, Lee. Appreciate it. David?
Josh Lerner was my professor, so glad to hear the shout out. So question for Ron and maybe an opportunity for 361 and Rom. I've been part of negotiations with some anchors and platforms for my firm. One of our challenges is there aren't good benchmarks available for economics for a platform or anchor into an emerging manager, as contrasted with just being a regular LP where there are well-publicized benchmarks for typical fees. So whether you're on the GP side or the LP side, do you have any data you could point to on typical structures and benchmarks for early LPs / anchors / platforms into emerging managers, which you, and I agree, identified as a pattern?
The answer is no, and that's why it's an opportunity, because you're still really early in this, right? So I don't care if you're making widgets or whatever you do. If you have an industry that's inefficient, fragmented, siloed, and relatively new, And remember, this industry, everyone talks about family offices, but 68% of family offices started since 2000. Half of those started since the crash. So this is a brand new industry. You combine that with the fact that the model doesn't work because 25% of families make it to G2, 10 to G3, and 5 to G4. So there's a inherent problem with it. And I think that with what's going to happen with to your question with emerging managers, probably what I see happening and what we've done a few times is a family office will become an anchor investor. They'll become part of the GP of the emerging manager, and that's typically how it's going to play out. And then the economics is really a negotiation between you and the family office. But I do think there's a big opportunity for family offices. The rich people want to find the smart people, and the smart people want to find the rich people, and they want to be an anchor in these investments. So you could find an anchor; they would just be part of the general partnership, and create an alignment of interest where it makes economic sense for them. But it also gives you the ability to do what you do well and not spend 50% of your time raising money. Because the problem with emerging managers and ICE or in a hedge fund, you spend way too much time raising money. It's not fun. It's not really what most people like to do, and you probably spend 50% of your time doing it. So if you could take care of that, you give up a little more of the pie, right, in the general partnership, but then you just do what you like to do, and you're pretty good at it. To me, that's a better model.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.